Good morning, everyone. Welcome to this new live sessions this morning. And today, very excited to have a special guest with us. We are here with Eric Young. We have your Twitter account here. For those who want to follow you, is King Kong 9888. And welcome, Eric.
Thank you, Fabio, for having me on your show.
Thank you. So before we start, the session for today is going to be focused on precious metals, in particular gold and silver. Clearly, we've seen a lot of activity, especially over the past few months, on those assets. Before we go into that, maybe if you want to give us little bit of a background of what you do and your experience, that would be awesome.
So, I've been in contract manufacturing for 20 years plus, and precious metals investor for approximately like really heavily into it, 5+ years, maybe 6 years. Okay, but I've been buying gold on and off for over 20 years. So I really, went heavy into buying gold. Around 2018, 2019, when the repo crisis happened, when Trump was in office for the first time, and he forced Jerome Powell to pivot for the first time during his first term. So when he did that, I thought, hey, these guys are just going to crank up the printer. They're going to stop printing. And I looked around, and gold at that point, I believe, was at around $1,200 US per troy ounce, and I just backed up the truck and loaded up. So that's, long story short, that's my story.
Okay. And that's interesting. So obviously, and then on Twitter, you always produce a lot of content, especially focused on gold. For those who haven't really been following what's been going on, maybe can you give us like a summary of your take for what's been happening in gold for the past few months and what's been the driver of it?
So really what happened is after the 2020, 2021 gold price rise. So gold went from like around between 2018 to 2021, it went from around $1,200. Well, actually, the lowest it went to was $1,100 per troy ounce. Okay, back I believe in 2018. So that was the lowest point, and then from there it went all the way up to around 1450 pre-COVID, and then COVID happened in 2020 March, and they took gold down, back to the I guess the low 1400s. So it didn't really stand it that much. So actually, I think it went to 1600. Okay, 1600 pre-COVID, and then during COVID they took it down to the low 1400s. So anyway, after COVID, gold went from the low 1400s all the way to I believe the highest before consolidated was almost $2,100. Okay, and then in 2021 they you can call it slamming, you can call it consolidation, but gold went from that high point to its lowest point in 2022 after the Russian special military operations initiation in Ukraine. They took it all the way down to approximately 1650. Okay, so $1,650 per troy ounce, and then from there, 2022, gold just went, step by step, it went up to where we are today, which is, if you look at the spot market, it's around $3,500, give or take.
Yeah, I'm just opening the chart here. So yeah, we're at $3,563, right?
Correct. Yeah.
Yeah. So the other question that a lot of users would have, like, do you think it can break? So that we have obviously a big 3600 level or 35, the range between 35 and 3600 is going to be a big range to break. Do you think it has room to grow, or what's your take on the price action that we see in the recent weeks?
So gold really consolidated already for approximately 5-6 months, right? Like since April. From let's just say 3,000 $3,250 to approximately $3,400. Let's just say that $200 give or take.
Yep.
It keep bouncing, between that range for the last 6 months, 5 or 6 months.
Yeah.
And recently I'm talking about last Friday, right? It broke through. It went right through $2,400, and now we're at, like the audience is saying, 3,560 approximately. So what happened? That prompted gold and also silver to break their consolidation range to this new high. Well, what happened is that first of all, I don't know if you're aware, but the European Union is now seriously thinking of confiscating the Russian assets that it froze. So that's one thing. Okay? So point number one. Number two is that India, Donald Trump has been trying to slap major tariffs on India in excess of 100%. So that, tough rhetoric and negotiations are going on. And India, over the weekend, India's central bank announced that it's going to, or it probably is doing it already, reducing U.S. Treasury bond holdings by the Indian central bank, and increase its physical gold holdings. So you see how that is a major news headline for gold? Because before it was just really, really Russia and China. Now the big three, right? China, Russia, India, are all saying that they are essentially minimizing the use of U.S. treasuries, but upping their, uptake of physical gold as their primary reserve asset.
Yeah. All right, and of course, obviously over the past few years, China has also been a big source of demand for gold. Do you want to maybe share some insights there on how you see the position of China affecting the price of gold?
So that's a very good question. Since the beginning of this year, China did 3 different things that really propelled its uptake of physical gold. Number one, it started a program. It's called the Gold Accumulate Program, where it allowed its citizens to directly buy physical gold from its commercial banks, like a savings account.
Yep.
So you can save money in that gold accumulator account, and once that dollar amount or RMB yen in China hits a certain level, that is the minimum, let's say RMB yen equivalent of a gold bar or gold coin, you can physically withdraw that physical gold. And that physical gold is directly from the SGE, which is the Shanghai Gold Exchange. So that's a game changer, because now you have, essentially almost direct access of the Shanghai Gold Exchange gold by retail customers. Okay, so that's one thing that they did. And then the second thing that China did was to open up its insurance sector, insurance companies, to allow them to utilize 1% of the assets under management to be invested in physical gold. That's huge, Fabio, because that equals to approximately 350 metric tons of physical gold per year, in addition to what China is consuming already. Now, the SGE delivers approximately 1,450 metric tons of physical gold per year before any of this. So that 350 metric tons would equate to approximately 25% of that.
Yeah. And another thing, like, how do you see the demand for the physical kind of like gold, meaning like bars or coins, versus the financial ETFs in China, for example? Do you see like a big spike in both the financial and the physical, or just at the physical level?
Fabio, both, right? Why do I say that? Because um, a lot of investors in China, the ones who are very traditional or they play it safe, they do withdraw the physical gold. Like the SGE has a approximately 70% withdrawal rate. That's humongous. um, my friend from X, PM Buck, they did a survey on or he did some research on the COMEX physical silver withdrawal rate. It's around 25-30%, even with the situation that we're in right now, which is, as you know, very critical in terms of like physical gold and silver, inventory availability, right? Based on what we saw at the LBMA earlier in the year. So compare that, okay? Compare those two places. One is around 20-30% in a extraordinary circumstance right now, which a lot of players are withdrawing in the West, right? Whereas in China, it's close to 70%. So to answer your question, I think yes, there are a lot of players in the ETF space in China, but those are primarily the institutions that want price exposure to physical gold that may not want to have the additional cost associated with gold storage and physical gold storage and security, right? So they buy the ETF, or just individual gamblers who want, again, price exposure to to the gold price, but they may not necessarily want the physical gold itself.
Makes sense. And then I'm gonna have another question, which is gonna be important for our retail customers. But the other driver of gold demand has, of course, been central banks around the world that have been really buying more and more gold in the recent years. Can you explain your take on what's really driving this accumulation of gold? Is it really a de-dollarization, so meaning like stepping away from their exposure to the US dollar, or are they diversifying their reserves, or are they actually using that for hedging the inflation?
So a couple of things going on here, Fabio. The U.S. government, federal government, has 37 trillion US dollars worth of debt,
Yeah.
and it's climbing. It's almost 38 trillion now. They're adding around, sometimes sooner, sometimes quicker, sometimes slower, but around approximately 1 trillion US dollars per maybe 4 months, 4 months, sometimes 6 months, right? But like I said, depends on the situation that they're in. So that's a big problem, because like there's no way that the US is ever going to pay that back. And who are buying all these debts in the past? It's the foreigners. So the foreigners are going to be left holding the bag, right? That's number one. Okay, number two is that what I talked about earlier on this program, which is the West. This includes the US government. They have done what? They froze Russian assets since the Ukraine war happened, right? Since the Ukraine war started. That's a big no-no. Why is that? Let's say you are India, you're China, you're some country that the US may or may not like or neutral to, right? One day you make the US upset. What is the US going to do? They might just freeze the US Treasury bonds that you hold.
Yeah.
So that's essentially, I mean, like, how do we know how long they're going to freeze it? Like Russia, they're frozen it for 3 years now and counting. It can be indefinite, right? They can, if you're freezing it without an end date, that what happens to the face value of those U.S. Treasury bonds? Zero. Am I correct? It's
Yeah.
just worth nothing, right? So
Yeah.
for these foreign countries, it's just better. It makes more sense for them to hold something in their own hands, which is physical gold. And that's the reason why they're migrating, from the US dollar, US treasuries to physical gold.
And do you see, you mentioned, of course, India, China. Do you see other really big central banks around the world leading this kind of like trend, this demand? And what are the countries that you see that are mostly buying gold right now?
Well, absolutely, Fabio. I sent you a chart. I don't know if you can pull it up, but it shows, something very profound, which is not this one, which is the global central banks holdings of US treasuries are now below their physical gold holdings. So after 30 years, okay, global central banks' physical gold holdings now exceeds, okay, more. It's more than what they hold US
Yeah.
treasuries.
Yeah.
So that should answer your question.
Yeah. Makes sense. All right. And then, guys, if you have questions for Eric, please paste them in the comment and we'll be able to answer those live. I have like a very basic, maybe, but not basic for everybody, which is really what is the difference between investing in gold by buying physical gold versus buying an ETF? And what are the risks for a retail trader that, because a lot of retail trader, they obviously invest in gold ETFs like GLD or
Mhm.
the iShares, but what really is the risk in investing in gold, thinking of holding physical gold, but in reality you're holding a financial asset versus actually buying
Mhm.
uh, the actual physical gold? Because I think a lot of people get confused there as well.
Okay. So if you hold an ETF, they have a minimal withdrawal rate. Most small investors, they don't make the minimal requirements to withdraw the physical gold. So all they're holding are pieces of paper that are essentially just price exposure to
Yeah,
the physical gold price. That's it. Okay. The people who can withdraw the physical gold from the ETFs are what we call the authorized participants, the APs. Okay. So they can go in there and take their, GLD shares or SLV shares or whatever, and they can redeem that with physical gold and silver from the ETFs. So as a small investor, like number one, you just bought basically a piece of paper that is exposure to physical gold or silver, right? You don't really own the physical gold or silver. And the second risk that you might have is, let's say, overnight, let's say over the weekend, something really big happens. And gold goes from, let's say, right now we're at $3,500, let's just say, okay? And then next week we're at 7,000. Well, there's a clause in these ETFs that is called force majeure. What they can do is they can just settle your ETF price, okay, at the last trading day price. So they don't need to pay you theoretically, the $7,000. They can roll it back and just pay you the $3,500.
Okay.
I mean, they did that with the nickel trade at the LME. They canceled a whole bunch of paper trades, and they just rolled it back like to the price from the previous trading day. So it's not something that is unheard of.
Okay. So as a retail trader, like obviously with smaller capital, what would be the best ways to invest in gold? Like,
I, I would say buy the physical gold, like buy like a maple gold coin or an American Eagle or like a gold buffalo,
yeah,
and just try to get the lowest premium possible when you buy the coin
okay,
or the bar. Yeah.
yeah, makes sense. Well, let's see if we have any questions here from the audience. All right, so I want to shift a little bit and looking at the futures market. Here, what we see, Eric, is I don't know if you have a chance to play around. We are building analytics to look at gold across different assets, ETFs, futures, and we also have CTAs. So we're going to talk about that maybe in a second. But overall, what we see is from not only from the obviously technical perspective, but from the option standpoint, we see like a very strong positioning, positive positioning around these 3,600 levels. So this is really the target that we are seeing coming from the option market. Our support level coming from the option side is at 3,275. And here what you see are the top strikes that are really have seen a large positioning coming from the future. If we go on GLD, we can also look at the ETF side. So we can also go over what the ETF is telling us. But overall, what you see here is we are in a very, very bullish environment coming from the option side and the momentum side. Obviously, the price action has been very strong. So just to show you guys some of the things that we see. If we look at the next expirations, we don't really see any negative positioning there. So overall, we are all, here we're seeing, today's expiration, Fridays and September. So we are targeting those levels there coming from the option market. And then if we look also like at the other matrix, we look at across the whole option chain, we see like obviously positive positioning across the board. Big expiration is going to be September 19. This is like the quarterly expiration for GLD in particular. So pay attention to that. There's going to be a lot of like options expiring on that day. And then the other thing, I don't know if you follow CTAs funds, and if that pays an attention to your analysis, but we can go into that a second. Let me know if you're familiar with them or if you follow them.
The COMEX has their reports that I can access and look into, but there's so much happening on the macro side that I'm really focused on that for the moment right now, and not really on the day-to-day trading data that you have that you have pulled up right now just now. Yep.
All right. And then before we were live, you were mentioning what's going on in silver. So I don't know. Maybe let me see if there's any charts here.
Yeah. So that's the chart that I mentioned. That the central bank's holding of physical gold is now exceeding the global central bank's holding of U.S. Treasuries. So the yellow line is gold, and the blue line is U.S. Treasuries.
Yeah.
So you see the U.S. Treasury is dipping down and gold is going up, right? And that's reversing a 30-year trend.
Yeah. Makes sense.
So that's getting into miners. I don't know if your audience want to talk about that. Oh, this chart is good. We should look into this chart.
Yeah.
So that maybe your audience is interested in this.
Sure.
Because that's the gold price movement from 2005, I guess, if you want to go all the way back there. But I'm focusing on 2009 to 2011, or let's say 2012. So if you remember, Fabio, 2009 is when the European picks, like the Portugal, Italy, Spain, remember how all the sovereign bonds blew up back then,
Yeah, of
right?
course.
So they have that sovereign bond prices, right, in Europe. And it started in 2009 and kind of got under control in 2012, approximately. So gold went from, during that fiasco, gold went from approximately $1,000 to 1,900. So gold almost doubled.
Yeah.
And what do we see now? We're seeing, all these European and even US treasuries like getting like thrown out the window, essentially. Like the yields are breaking historic highs, and their market values dumped. So it's kind of like reminiscence to what happened during that period in 2009 to 2012. And if you look at that gold price movement, you see how gold would grind up, and then after a period of time, if you look at like 2009, okay, after that big dip during the GFC, it started going up, 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 and then you see the big green candle where I pointed and say most smarty pants sell their miners here, right? That candle. And then right after that big green candle dipped again, right? And then it grinded up again, like that.
Yeah.
So I've been looking at different charts of different eras, and it seems like that's what gold does historically. So this time, breaking out of this consolidation range is a little bit different because we basically went flat for almost 5-6 months. So it hasn't been grinding up, it was consolidating sideways, and we're breaking out. So I don't know, but I'm not a chartist. From my perspective, I'm thinking maybe this breakout is for real. And your data is showing that too, right? That maybe there are legs behind this up move, and we might see 2,600 spot, maybe 2,700
Yeah.
from this move.
Yeah, I mean, we use the option data as kind of like a sentiment indicator for what the market is looking for. So when we see, for example, if we go back to our futures data, when we see our 3,600 here, which is a very, very strong, we call it core resistance, which is our call wall coming from the option side. So here is clearly a very big point that the market is looking for. So again, if we break through this level, what could happen? Again, we have strong positioning already above that, 3,750, 3,685. So there's a lot of already big positioning around that. But what could happen if we break there? Then yeah, it's to understand how that happens. But another important point is really that we need to be looking at the expiration in September, because there's going to be a lot of option expiring on that day. So that's going to be relevant as well.
Yep. And while nobody knows if they will snap a lot of sauce on that day, we don't know. It's very possible that, like I said, it will break out of this upper range and go to the next stage, just like what you said. Very possible.
Yeah. And in terms of how can traders, especially we have a lot of customers who are trading the future side, what are the things that you'll be looking for over the next few weeks or months? Or are there any specific events that you are watching or monitoring? Obviously, the whole thing with the interest rate is going to be key, but are there any other important event that you're going to be paying attention to?
I think we should pay attention to what the BRICS does, like the BRICS, the China, Russia, India, Saudi Arabia. If there are any additional news that they release, if they are making additional moves towards, like you said, that term, de-dollarization, and like as you've said, Fabio, the interest rates. We have
Yeah.
to see, like, even if they don't cut interest rates, but there's a whole fiasco going on at the Fed, that might actually help gold, the gold
Yeah.
price,
Yeah.
right? So, like, gold likes chaos. Any kind of chaos that happens at the White House, at the Fed,
Yeah.
is going to help gold, in my opinion. That's it.
Yeah. Makes sense. All right. Let's see if I have any questions. Let us know, guys, if you have anything that you want to ask Eric in the meantime. Anything you want to add on your side, Eric, that is important for users or traders who are looking at gold in particular, or silver as well?
Okay, so that's a very good question, Fabio. I think if your viewers are leveraged, like, when you talk about futures traders or options traders,
Yeah.
naturally they are leveraged.
Yeah.
Am I correct? I
Yeah.
mean, I trade leverage options too. That's fine. But my recommendation to anybody who is leveraged up to maximize their price upside exposure to gold and silver, I recommend these people to also buy some physical gold and silver. Why do I say that? Because that's your anchor, Fabio. That's your anchor, right? So even, let's say, if the price of gold and silver corrects for, like, the short term, your physical gold and silver, the price correction for that is nowhere going to be near the price correction that you feel with your leveraged option or futures. And in the long run, that's just going to help you to stay in the game. So, again, any of your viewers, if they are interested in buying those products, I would say get some physical and hold them in your own hands.
Yeah, and for those who are not familiar, like how does like a small investor or a retail trader actually buy physical gold, right? Because of course, with the trading application, you can simply trade an ETF, and basically that's easy. But at the same time, there are risks behind actually trading the financial product versus holding physical. So where would a small retail holder buy physical gold? Can they do it through their banks? Can they do it through other venues? What would
Okay.
you suggest? Yeah.
Well, in China, they can do through the banks. In Hong Kong, they can go through the big smelters. Like Wing Feng. They're a big smelter for the HK Gold Exchange, and they deal with the public directly.
Yeah.
So you can buy from them, open an account, go into the office, and they have, they say they have whatever gold you need. They will give it to you, okay, at a very, very low premium, less than 0.5%.
Yeah.
Buy sell, buy sell differential, whatever you call it. In the US, I see a lot of people buying the gold and silver from Costco, your local con shop, if you can get a deal from your local con shop guy. And so I think it's not a matter of not being able to get it. It's just
Yeah.
people got to, for lack of a better word, they got to get off the lazy ass to actually go get the physical, because that takes some work.
Yeah.
That's it.
Makes sense. All right. So we have a question from Joel. Good question. I'm gonna read it to you. So, is there any scenarios that you foresee that would cause a correction in gold and silver prices in the next 6 months to a year?
It's a very good question. I do see that happening if, let's say, the US or elsewhere in the world, but primarily in the US, gets into a liquidity crisis, like a US dollar liquidity crisis, similar to March 2020. So if that happens, I see everything selling, like US equities, just everything across the board, like bonds, potentially physical gold and silver, all the miners, because they are just equities of gold and silver. So yeah, so if that happens, I see everything imploding.
Yeah. Okay, makes sense. Yeah, and that's what exactly what happened during COVID, right? When for those who are not don't remember, even during a period of crisis, the gold kind of sold off because there was a liquidity crisis. So everybody needed to have cash, and the best way to have cash is to sell the most liquid asset, which include golds and treasuries.
Correct. Uh, it's just that, potentially, gold may get sold off the least, right? Because now all the foreign central banks, they're holding physical gold and they're not going to sell. So, gold might correct, I don't know, like less than 10%, but all your miners might get devastated. And silver might drop way more than 10% because silver's price action is a magnification of gold's price action.
Yeah, absolutely. Makes sense. Okay. Yeah, let us know, guys, if you have more questions. I touched all the points that I had for you. Let me know if I miss anything.
No, I think we're good, Fabio. You
Yeah,
really, you got it. Yeah, thank you.
Yeah, and I really appreciate your contribution to this, to being on the talk. And for those who want to follow you, I'm gonna post here your X account, which is King Kong 9888. Really good content. We love it. We follow it, and I really thank you for being here with us today and giving your perspective on a market that we might not talk about as much, but is really important for what's going on in the market right now.
Thank you, Fabio. My pleasure.
Yeah. Thank you. Have a good day, guys.
Thank you.